They tell you to follow smart money, whales, institutions, insiders, the people who really know. But here's the uncomfortable truth most traders never hear. Smart money isn't smarter than you. It's positioned differently. And that difference changes everything. Picture this. Two people walk into the same casino. One has $100. The other owns the building. They're playing the same game, using the same cards, watching the same wheel. But only one of them can't lose in the long run. That's smart money. Not genius. Not secret indicators. Not mystical foresight. Structure. And right now, understanding that structure matters more than ever. Because retail trading has never been louder, never been faster, never been more crowded. And yet, the same group keeps winning. Quietly, consistently, almost boringly, while everyone else argues on social media about entries. So let's slow this down, strip away the hype, and talk about what smart money actually means. Not the myth, the mechanism. Start with a simple lie the market loves to tell. Smart money predicts the future. It doesn't. Prediction is fragile. Prediction breaks. Prediction dies the moment a headline hits. Smart money doesn't predict. It prepares. Imagine you're managing $1 billion. You can't just click buy. If you buy too fast, price explodes against you. If you sell too fast, the floor disappears. Your problem isn't direction. Your problem is size. This is where the story changes. Retail traders think in trades. Smart money thinks in inventory. They don't ask, will price go up? They ask, where can I accumulate without moving the market against myself? That single question explains almost everything strange you've ever seen on a chart. Why price stalls. Why it spikes and instantly reverses. Why it hunts stops like it has a personality. It's not manipulation in the cartoon villain sense. It's logistics. Let's make it painfully simple. If a pension fund needs to buy 10 million shares, it cannot buy them at one price. There isn't enough liquidity. So it spreads that order across time, across levels, across emotional moments, breakdowns, fake rallies, quiet ranges. Every time retail panics or celebrates, liquidity appears, and smart money quietly takes the other side. Here's the irony. Retail traders are obsessed with timing the move. Smart money is obsessed with surviving the move. Because they're playing a longer game. They don't need to be right today. They need to still exist next year. This is why smart money concepts are so often misunderstood. People copy the patterns. They mark the zones. They wait for the break. But they miss the point. Smart money isn't a strategy. It's a constraint. Institutions are trapped by their own size, and they've learned how to turn that trap into an advantage. Let's talk about stop losses. Retail traders place stops for protection. Smart money place stops as information. When stops cluster, they reveal where liquidity lives. Not because people are stupid, but because risk management creates predictability. That predictability is exploitable. So price moves to where stops sit. Not to hurt you, but to fill orders. And yes, sometimes that means your stop gets hit, right before the move you were waiting for. That's not bad luck. That's structure doing what structure does. Now here's where the story gets uncomfortable. Smart money doesn't win because retail loses. It wins because retail provides the liquidity that makes large positioning possible. Without retail, markets would be thin, volatile, untradeable at scale. Retail isn't the victim. Retail is the fuel. And that creates a strange relationship. One side needs speed. The other needs depth. One side reacts. The other waits. One side wants certainty. The other thrives on uncertainty. That's why smart money trades look boring when you zoom out. Long periods of nothing, followed by sharp movement. Those quiet zones? That's accumulation. Those violent candles? That's execution. By the time the move is obvious, smart money is already managing exits. Now, let's puncture another myth. Smart money isn't a single group. It's not a shadow council. It's pension funds, insurance companies, market makers, hedge funds with very different mandates. Some need yield. Some need hedges. Some need neutrality. They often disagree, which is why markets feel chaotic. But chaos at the surface doesn't mean randomness underneath. It means multiple objectives colliding. Think traffic, not chess. And this brings us to the most important distinction of all. Retail trades price. Smart money trades risk. They think in distributions, probabilities, scenarios. Not this will happen, but if this happens, we survive. That's why they scale in, scale out, hedge, delay. And that's why copying their entries without copying their risk framework is pointless. It's like wearing a race car helmet while driving without brakes. The helmet isn't the edge. The system is. So why does this matter right now? Because modern markets amplify these dynamics. Algorithms react faster. Liquidity appears and disappears in milliseconds. Narratives spread before facts settle, which means emotional traders are providing more liquidity than ever. And smart money is adapting faster than ever. The gap isn't closing. It's widening. Here's the quiet punchline. Most people who talk about smart money are still thinking like retail traders. They want confirmation. They want certainty. They want a clean signal. Smart money accepts ambiguity. It operates in gray zones, incomplete information, uncomfortable timing. It doesn't need to look smart. It needs to work. So the real meaning of smart money isn't intelligence, or secrecy, or even advantage. It's patience plus scale, inside a system that rewards liquidity over logic. And once you see that, charts stop looking like puzzles and start looking like negotiations. Between urgency and patience, between fear and capacity, between those who must act and those who can wait. The unsettling question isn't, how do I trade like smart money? It's this. In a market built on liquidity, are you trading? Or are you providing it? And if the answer makes you uncomfortable, good. That discomfort is closer to the truth than any indicator ever will be.